Hello everybody and welcome today to the BMT Tax Depreciation webinar for commercial property owners. We've done residential properties today, and so it's a bit of a webinar day. Now we're going to go through and do specific related to, I guess, non-residential properties or commercial properties. So thank you for attending. It's good attendance. Well over 1,000 people attended. I've registered for these couple of webinars today, which is great. Some interest in depreciation, and because it makes such a big difference to the dollars. So depreciation obviously makes a big difference. What I want to do today is for specifically non or commercial properties, give an idea and some session on what it is, what it means to investors in properties, and some tools you can use to help, I suppose, with your decision-making process, but understanding what difference it does make, and some of the things about depreciation that relate to commercial properties is important if you're thinking about, or you do already invest in commercial properties. My name's Bradley Beer. I'm the CEO of BMT. I've been part of the furniture here for nearly 26 years. Next month it's 26 years of its 27 years of operation. We're about 200 people. We're spread over the whole country, doing depreciation schedules, predominantly that's about it, basically all we do. And I've done close to 1 million of them. I think next year 900 and something thousand of them. So we should click over that million depreciation schedules not too far away, which is exciting. It's been a great journey. So today, I guess first let's get into, so we've got to allocate about 45 minutes. Feel free to put some questions in the sections in there, wherever you do. And I've got someone who can answer them on the way through. We'll answer them the next 24 hours if not. But also, if you think of something tomorrow, feel free to send us some questions. We're always happy to talk depreciation and answer them. What is it first? It's wear and tear of buildings and a claim that we get to make because of that. We understand depreciation, I guess, when we talk about our cars, because we buy them, we drive them out of the shop, and they become instantly less valuable, or they depreciate in value. If you use that car for business, you'll get to claim some of that depreciation or loss in value each year. It works similar for buildings that are used for investment, which is all commercial properties are basically an investment, because you shouldn't be living in them. Principal place of residence or house has no depreciation, but commercial properties, if they're used as for your own business, they're still seen as an investment property for depreciation. So you get to claim the wear and tear on the bricks and mortar, the carpet, the stoves, or the air conditioning systems, and the things in your commercial investment properties. Makes a pretty big difference, because it's a big difference to the cash flow. We're buying properties in this country usually to try and make money, and we make that through either through capital growth over time, and also through the cash flow over time. And the depreciation makes a pretty big difference to the cash flow scenario. We'll run through a bit of that today and go, what difference does it actually make if you make sure you take advantage of this properly? So simple, things wear out, make a deduction for them. Why does a quantity surveyor do that? I'm not an accountant. I do have a tax agent's number with the Tax Practitioners Board for the purpose of doing depreciation schedules, not for the purpose of doing tax returns for people, which we need to make sure we have as a quantity surveyor doing depreciation schedules. But the reason I've done a building degree, so we come out as a quantity surveyor, which is someone who knows how to measure and estimate construction costs. So we get involved in projects, or we can, at different stages. We can get the plans, we can measure up, we can count the bricks, we can measure the amount of concrete, steel, carpet, whatever components of a building, the roof. We can measure up how much of it is there, so you know how much to order, and also how much should it cost to actually build it. So we don't build it, but we can estimate how much it should cost someone to build it, including everything associated with that building. And the reason that this quantity surveyor person gets involved in depreciation is that the claims that we do make for depreciation relate to the cost of construction of the building and the value of the items within it. So the tax office will accept the estimate for construction cost of a building done by they say a relevant professional such as a quantity surveyor. So if you don't have all of the original actual costs, they'll accept the estimates done by a quantity surveyor. Alongside that, I guess, compliance piece, you need to know the rules around depreciation, what you can, what you can't claim. How do we get the most out of it is the important question, as well as the, I guess, making sure we're legitimate in our estimating and we stack as far as an audit is concerned there. That compliance is the word I was looking for, sorry. We've also got to understand the rules around depreciation to help get the most out of those properties. We work alongside the accountants. We're not accountants, they're our friends. We work with them to do one of those numbers on the page. Just like to draw attention a little to I guess the Australian Institute of Quantity Surveyors, which is our governing body, and they've been through a bit of work with the industry it took a while, but it is now out, a practice paper that's been put out around trying to make sure that the quantity surveyors that are normally estimating construction do understand and properly produce depreciation schedules. A couple of the key things or points around that we've drawn out of that here, in particular around site inspections. Our industries sometimes going to site, sometimes not going to site. We go to site because we think it's important, and the ARQS, if you read that paper, would I guess be probably in agreement to that, given that they think if a quantity surveyor can't do an inspection on the property, that the disclaimer needs to say that it may not be accurate. To me, making sure we're capturing everything, capturing additions, maximising the legitimate deductions and minimising the risk are very important to get to site and see these things, as opposed to looking at some photos, which seems to have happened often. We don't pay referral fees to accountants for providing schedules to yourselves as investors. And look, once again, in that paper, not aligned with the ARQS code of, the code of conduct is not something I think it's aligned with, and formal disclosure needs to be given. Our money goes into making sure we get proper reports that maximise the deductions, as opposed to flicking any accountants or whatever part of that money. Your money goes towards that, not towards any referral fees from us. Retail shop. What I've done is put together a case study example of what happens if we claim depreciation against. I've done a couple of properties here. What if we do? What if we don't claim it? What difference does it make to the cash flow? Because that's really, at the end of the day, the important thing. If we've got an investment in a property, what does it mean in cash? Let's take this retail shop here. Someone's bought it, $875,000. The rent, which is quite good on this one, of $1,340 per week, meaning the income of is $69,680 for the year. Expenses, we're going to have to pay the interest, rates, management fees if there is those, and obviously some of the outgoings are paid by usually some of the outgoings are paid by the tenants in these properties, but it depends on the agreement, of course. But let's say there, as an estimate, about $62,000. What that means is that this property is actually a positive cash flow property, returning about nearly $150 a week to the owner of this particular property, which is great, or $7,600 per year. What happens is that if this is owned by an individual, that income of $7,660 would add to the taxable income of the person that owns it. So add that to the income. If they're on a 37% marginal tax rate, that'll mean that they'll pay an extra $2,800 in tax. So after tax, they end up with $4,800 in their pocket, or about $93 per week. With depreciation taken to this, what depreciation does in this scenario is mean that there's a deduction for the wear and tear on the property, and in this scenario, we think in the first year about $43,000. What it means is that you're no longer going to pay a tax on that $7,600, but you're also going to then generate an on-paper loss of another $35,000, meaning the refund, if all of this is in the same marginal rate, would be about $13,000, changing your cash flow from $4,800 up to $20,000 a year. or a total of $402 a week. So claiming depreciation, providing that the entity that owns this has other income that they can write these losses against for depreciation. The difference is $300 a week in making sure depreciation is claimed, providing the entities have got the appropriate incomes otherwise. This is assuming it's owned by an investor in their own name, and that is usually the tax rate that most investors are on. Obviously changes if you're at a higher marginal tax rate, but for the sake of the example, it does make obviously a substantial difference to come up with maximum depreciation. My job on that whole page is just to come up with that $43,500 number and obviously make it as high legitimately as we can. Second scenario, and I've done this as a small business entity, the tax treatment is obviously a little different. Let's take this one and see what happens. Industrial shed, $650,000 purchase price. Let's say the rent's $850 a week. Income $44,000, expenses $56,000, kicking in. This one is negative. It's a negative cash flow of $12,200 a year, or about $235 per week. We can see the depreciation claim there of $37,000 against that particular property, meaning our deduction now is rather than the $12,200 plus the $37,000 depreciation, total loss $49,200. An SBE will have a tax rate of 25%, meaning the refund across that would be $12,300. And this particular property turns from a negatively cash flow property into a positive cash flow property of $100 a year, or about $2 a week. Not going to make a whole lot of difference, cup of coffee every 2 weeks, but a positive cash flow. However, it does make a lot of difference. It was $176 a week negative before we added depreciation into this situation, and afterwards with that tax credit or the tax saving related to depreciation ends up being something that doesn't cost them anything, providing obviously there's some income in that entity that owns that. So depreciation, once again, make a big difference to the cost of owning these properties. How does it work? There's two areas that the claims are made under. The first one is what's called the Division 43, or the capital works allowance, relates to the structure and the fixed assets. Windows, doors, locks, kitchens, and kitchenettes, walls, floors, roof. The hard stuff, things that last a long time, they get a claim of 2.5% per year, up to the total construction cost at the time they were built. In order to do that, we'll talk about dates in a moment, but they need to be built after what was 1982, but we'll touch on that in a moment, in order to claim this deduction. But if something was $500,000 to build, it ends up with a deduction of $12,500 per year. If it was built in 2015, it's got 40 years of claims, so till 2055. If you're to buy that now, you don't get the first period. You get to get these claims for the rest of ownership, but it is $12,500 per year. So the longer if it fits within the age, obviously this building allowance creates quite substantial deductions. Put the dates up here just for some reference. You can see the non-residential stuff actually started from July 1982. But if you add 40 years to that, as we're going to do in our head, that puts it to 2022, meaning buildings that did qualify then have actually now run out. So really anything built since 1987 is now the same basically as residential properties, has this building allowance component claimable. So anything from that day onwards still gets some deductions for 40 years after it was built, a few years left in those as yet. These dates that trigger these things are based on commencement of construction, but the claims actually do start from the completion of construction. So if there is anything that started before July 1982 and took 3 years to build, there could be something left, I suppose, because it does based on completion of construction. Anyway, the other part, plant and equipment, or Division 40 as it's known, these things are more things that are usually easily removable or mechanical or electrical. There's a list of them that the tax office puts out. They put an effective life on them. They're things like, chairs, security cameras, ovens, fire control systems, carpet, air conditioning systems, things that don't last as long. Tax office will allow you to claim them over how long kind of they're expected to last. These things don't have age-specific dates. We put a value on them at the time you purchase them. So even if they're older, they're still there serving a purpose, still could have some value. If your carpet is 50 years old, I don't know if it has much value at all, but we go through and look at the things like, you know, there's not a lot of 50-year-old carpet around. Things have been replaced over time. So if you buy an older building that has had some work done over time, we'll go and assess that over time and see what we can find that might still have some deductions available. The example here, dishwasher, what's it look like? 2,800, it's 25% in the first year, or $700. Obviously, this is much more than 2.5%. So the more of these things that we can find, the better inside your properties. On these plant and equipment items, there's about 6,000 of them in total, and trolling through the tax officer's site to find them can be interesting. So we made an app out of that called BMT Rate Finder, and it's free app. You can go in there and as you can see the list of things that exist. They've got what's called an effective life, and we put a depreciation rate against them that relates to that effective life. There is also another app called BMT Resi Rates, which just does the ones in residential properties, because obviously not as many. There's about 180 or 190 odd in residential properties, but in non-residential properties there's a lot more. But then they're just conglomerated into those 6,000 non-residential property assets, which include everything from your photocopier to your furniture in there to your gas heaters, garbage bins, and whatever else that you may want to claim depreciation against. So within things that are not building, those effective lives still relate, and the value that's pushed against those gets claimed and depreciated based on the same effective life that's inside that app that the accountants can use to find them easily. Owners or tenants, this works for both of the above. Owners claim what they own, tenants claim what they own, basically. So, you know, it's often worked out within the lease as to who actually owns what. Owners are usually most of the structure, because it's pretty hard to take that away. And a lot of these sort of fixed plant equipment, AC, fire safety equipment, etc., is usually the owners. The thing to consider as an owner, if you are buying or owning a commercial property, is when tenants actually leave equipment there, that you may actually take over ownership of that, and there may be some value able to be attributed to that for the purpose of depreciation and claim. So if you do take on other stuff that's in there, sometimes there might be something available. Tenants that are occupiers, the things they normally own are obviously the loose stuff. If they've done fit outs, joinery, they own, if they own that, then basically whoever owns it gets to claim the depreciation against it. And if it moves out of the property pretty easily, it's, you know, more likely usually owned by the tenant as opposed to the owner of the building. Small business incentives. So there's been a number of, or a raft of changes to these over the last number of years, since back in the early days of COVID, and even before actually, especially with farms. A lot of changes and things have happened. As of the budget last night, this one here has been extended for a year. There's a bit of conjecture as to what else may happen when things get finalised, but at this stage, this instant asset write-off, which has been reduced down to a value of $20,000 in the previous year, it was unlimited, and now it's a $20,000 total. So if you're a small business, you can claim up to $20,000 instantly on assets that you buy. No limit on the number of assets, and if they're over 20,000, they go into the small business simplified depreciation pool, and you can get some accelerated deductions out of them. And if they are over $20,000, when they do get claimed back to under a value of $20,000, they're immediately written off also. Businesses up to an aggregated turnover of $10 million who is eligible for this this deduction. So obviously good, because you get to instantly write off some of these things, and they've just extended that from 30 June 24 at this stage till 30 June 25 in the budget that was last night. The other thing that had some changes last night, but has been around for some time, is the small business incentives. This allows small businesses to add 20% to the cost of depreciating assets that support, electrification and efficient use of energy. So if you, as you can see from the examples here, if you've bought something, let's say we'll use the example that's here, I guess, electric cooling and heating for $11,220, you get to add 20% to that cost and depreciate based on that a total of $13,400 in the period of time, whether it's above or below that $20,000. You either get an instant asset write-off, or you get a 20% bonus on the value. Up to 100,000 of expenditure in total is able to be added, with a maximum of 20,000, which is 20%. Obviously, on top of that, what they have not done has changed in this budget. It's at this stage, it still looks to be ending on 30th of June 2024. But the thing they have changed at this stage is that it's now available to small, even though it's still called a small business incentive. They've made it available to small and medium businesses. So aggregated turnover, not to just $10 million, but also 10 to 50, which is a medium business enterprise. So up to $50 million, got a little bit of that extra turnover in business, got that extra 20% write-off for things that are done prior to the 30th of June this year. We look at each property individually, obviously, and apply whatever we can and do based on what type of entity owns the property, and obviously the values and things that we need to stick by. So even if you've got properties from previous years, there's a lot of other instant asset write-off things for small, medium and large businesses and farms. We look at it at the time with the rules that are in place and make sure we apply them to the properties that we do. Renovations, fit out and scrapping. I like to touch on especially scrapping here. In commercial properties, there's a lot of refit, probably more than there is in residential properties because of ended tenancies and other reasons. But before you start ripping things apart, let's make sure we've got a depreciation schedule in place. Why? Because everything that's in there you should be depreciating. Firstly, we've already addressed that, but the other important piece of that puzzle is once it's removed, there might be some unclaimed value based on what was left from a tax, from a depreciation point of view in value in those properties. So if there is something left, rather than just chucking it away or scrapping it, there is a potential to write off whatever residual value is left. We call it scrapping. We sort of made up that word for it because it's easy to understand. You scrap the stuff, it had some value left for tax, write it all off straight away in that year that you do that renovation and pull it out. So the other thing to consider here, obviously, if you're looking at upgrades and renovations, is if the tenant has left the fit out and you as the owner take ownership of that, there may be a value attributed to that, and maybe some things that before you rip it apart and decide to do something else with it, that you might need to consider if there's something valuable there still. For commercial properties, the things that we need to make sure we do is separate reports for multiple entities. So often the tenancy will be owned by, and what the regular one is, they've bought the building in the super fund, and the fit out is owned by if it's your super fund and your business, the fit out usually is often done by the business. So we need to separate those entities, even though you're the same people, they're in different entities. We separate those just the same as if it's owned by, the building's owned by a different person altogether. Anything that you've got that you're not sure, think maybe we might get something from, depreciation estimates and assessment is very easy and free. We'll have a look at it, review exactly what you are doing, thinking of whether or not there's actually some more, I guess, ability to maximize that deduction, go back to adjust some previous years if necessary, or if there's some dollars in that, but often it's not being utilized to the same extent that it can. So if we can find some more money for you, obviously we will. Reports make sure we've applied accelerated rates, general business pools, and as I said before, the current instant asset write-off available to business, or whichever one is applicable for the time that it's bought. All different types of properties, pubs and clubs. My surname is Beer, so hopefully we can work out the beer component pretty well and test it while we're there if we're lucky. Done lots of pubs and clubs over the last period of time, or over many of our years. Lots of, especially farms and primary production, have been changing over time, but everything, and lots of industrial warehouses, that market's been moving along pretty solidly over the last couple of years, not struggling like some of the other offices, for example, have been. So more of those means we end up with more a percentage of that sort of stuff. But any type of commercial properties, right down to, the Melbourne Eye has a depreciation schedule that we've done. The big Rocking Horse in Adelaide, once again, depreciation schedule. I think the Big Banana in Coffs Harbour may even have one as well. So all those types of properties, docks, boats, whatever, there's different things that have depreciation that we've got involved with. Poultry farms, some of the dollars available. I'm often, having met some poultry farms and looked at the way they do business, it's actually really quite interesting. We eat a lot of chicken, and the way that's grown had some interesting discussions. But anyway, poultry farm Gidley, the deductions over the lifetime over $4 million. Solar farms, done a lot of those over the last little while. One here in SA, $205 million worth of deductions. There's a lot of those being built. Obviously, better way to get power, I would hope, and some big deductions around those. Sydney Boulevard Hotel, $40 million worth of stuff in renovations. You can see it's an old hotel, but it's been renovated to be much nicer. There's $40 million worth of deductions, a few examples there of deductions that have been claimed. FA frequently asked questions I like to address because they're regularly asked. The one that we hear the most is, doesn't my accountant look up after that? Or I've got a good accountant, and I hope everyone's got a good accountant. A good accountant should have the specialist bits done by the specialists, and most of our work comes referred by accountants. They're our friends. We work alongside them. They're not our enemies. We're happy for accountants to be consulted on everything we do. Absolutely. We are that cost guy that comes in, puts the values on them. We actually visit the property, which accountants don't usually, to find everything we can to maximize that one or that deduction that produces those few numbers that help get better dollars out of those tax returns. So most of the time it's accountants who will do this via in some way and provide it to. Is it too old? We've touched on the older properties, but I'd like to always say that, old property doesn't get as much deductions, but it's always worth asking the question. Always ask a quantity surveyor who should know the answers, not your mates at the pub, because we will have a look at when it's built, what's been done, when it's been done, and we'll be able to give you an idea of whether it's worth doing before we ever go out and actually do it. Is it ever too late to claim? You can go back pretty easily and amend 2 years of tax returns. So, if you don't pay your tax, the tax office will make you pay it and probably fine you eventually. But if you don't make your deductions that you could have, you can also go back to them and ask for some money. Only for 2 years, they'll allow you to adjust to tax returns. We're coming up towards tax time, another tax year. Don't do another tax return before you check and make sure you're getting and taking full advantage of depreciation, even if you've owned it for 5 years or 10 years. If you haven't been claiming, you can only go back 2 years, but there might be some dollars there. You want to see if you can take advantage of those. Regular question we get, does the commercial building need to be leased to attract the deductions? And the answer is, doesn't actually have to be producing an income. It just needs to be available to produce income. Residential properties obviously get depreciation if they're used as rentals and not your principal place of residence. It's not a question so much with residential property because usually they get tenanted again fairly quickly. Commercial can lay vacant a little longer sometimes, which is one of the risks. But as long as it's available for income producing purposes, then that depreciation still applies. Capital improvements versus repairs. Improvements, you need to depreciate. Repairs and maintenance are instant deductions. Obviously, the more things that fall under repairs and maintenance, the better, because you get to claim them straight away. But if they are improvements, we need to add them to that depreciation schedule and claim them. We just leave them out, and the accountant can claim those instant deduction repairs at the end when you do the tax return. Capital gains tax, like to mention that because it's a regular question. The depreciation that you do claim will affect the capital gains tax that you do pay. The cost base will be reduced. Therefore, the capital gains tax liability when you sell the property will be increased. However, when you make depreciation deductions on the way through when owning it, you will, and once again, your entity will come into play here. Your ownership, the deduction should be made at your full marginal tax rate. And if you then sell the property at a later date, the capital gains tax that you do pay should be based on, if it's more than a year, based on half of your marginal tax rate. And we've run plenty of case studies on this. I'll provide them to you if you email me. Otherwise, you'll be able to find them hopefully on the Maverick newsletters on the website. Usually, under all those scenarios, and it wouldn't be every single one, but it can be done before you do the exercise. The amount of money that you get through claiming the depreciation on the way through is more than the capital gains tax, in additional capital gains tax that you will pay. And the other thing is you get the time value of money because you get it now as opposed to another date if you sell, and you do get to use that money on the way through. You reduce your debt, put it in offset, or I don't know, go on a holiday, I suppose. But you will need to keep some for that capital gains tax at a later date. A little BMT difference. Well, for all quantity surveying reports, the fee should be a one-off and tax deductible. The schedule is built to last the lifetime, the 40 years. We have over 18,000 regular referring accountants to this business. We don't pay them a referral fee for that. We just make sure we look after their clients and maximise their deductions. We do have a large market share, obviously, of depreciation schedules because we've been doing them and growing away in this business for a long time, making sure that we maximise those deductions and help the accountants to make it, well, try to make it easy for you and get them to the accountants. We turn them around fairly quickly. Had some struggles over the last couple of years with COVID and staffing, but we're back to turning them around a bit quicker at the moment, which is nice to see. Commercial ones are not quite as quick as resi at the moment, but we're getting there. But the important thing is making sure we get them done right, maximise that deduction, and if you do have any issues or questions with the ATO, we'll stand by when there's an audit to make sure we're going to defend what we've done because we've been to site, we're sure of it, and we get a few questions tax office, we answer them. So it should be compliant with the ATO. We don't outsource, we like to inspect the properties, as we talked about earlier. We don't outsource that process. Everyone that comes to site is a staff member of mine, and that's across the board nationally. They come from wherever they are to come out to if it's distance areas, to do those. The other thing is the BMT guarantee. We say double the deductions or you don't have to pay. If we look at your property and we think it's worth doing, think there's enough deductions there, we should be able to work that out from a few questions, and you can usually see some photos online or send us some. We'll give an indication of whether we believe it's worth it, and if we're not, we should know that because we've done so many of them by now. If we get that wrong and we start the process, we realise it's not at least double the fee in the first financial year, no charge, move on with their day, and make sure we do a bit more research on that next time. BMT, my BMT, just like to touch on here as far as the tools that are available to help you as investors. We built my BMT. It's a portal for your depreciation schedules with two things in mind, and the first one is around is live depreciation schedules. So once we do a depreciation schedule, I said earlier, we project it out for those 40 years of claims, but in the third year, you go and put a new bit of fit out or something in there, and obviously it's or some new carpet. We can't see the future, so your depreciation schedule is no longer correct with the things that you've got in that property. Inside my BMT, if it's just a couple of small assets, you at no charge can go and add your carpet, your windows, whatever, your blinds, or whatever it is, with what you've spent on them and what date you put them in there. It will actually update your depreciation schedule and show the new numbers for the year. The second part of why we built this was to be able to share that with your accountant. So out of those 18,000 accounts, I'm not sure how many of them are log in, but lots of them do, and they will be able to see all of their clients' depreciation schedules inside my BMT in one place. Not only will they be able to see them all, so old ones can be hooked up as well if you've already got them. They can see them, but also if you as the owner of the property adds some new carpet onto that schedule, the new numbers for that year with that carpet included will be shared with your accountant. So they're the two core reasons for building My BMT. You don't have to use it. You can just ring us and we'll do a depreciation schedule like normal. The idea is to make that somewhere that is easier for accountants especially, but also you can see everything in the one place. There's a few other things in there. They can be tailored. You can track the cash flows on your properties very easily. So if you, rather than having a shoebox or a bunch of PDFs, you can actually enter the costs in relation to the properties inside, and it pulls the depreciation from your depreciation schedule into this sheet that's set out the same way as the MyGov ATO. So you can then share that also with your accountant, and they can hopefully make that a little bit easier to do your tax return. Some other apps, free apps for investors, I guess the big ones, the tax depreciation calculator, that is something that you can use. It's free, comes up with approximate numbers when you want to look at what sort of deductions you might be able to get. You can also just talk to us about your property, and we're also able to give a guide over the phone at no charge of what sort of deductions might be there to see if there's any opportunity. PropCalc, we ran a couple of cash flows there on properties as to what it would cost to hold properties that you've got. PropCalc is a free app that allows you to do that yourself. It works out, you've got to put your own information there about the purchase price and what interest rate you're going to pay and your tax rate, etc. And it'll spit you out approximate cash flows. You can compare properties and use that when you're looking at properties to buy. Rep cost and resi rates has all those effective lives that are against the properties. Resi rates and rate finder, that is. Rep cost is a replacement cost estimate calculator for residential properties. So if you're trying to insure a residential property, it allows you to estimate what it should be insured for, should it need to be rebuilt, and allows for the appropriate things. Construction cost calculator, residential and commercial on there. It's got some rates for different types of properties. If you're thinking about building, developing, then it's the first, I guess, rough guide per square meter of construction costs that you can use. Once again, it's free. We do publish them on the Maverick newsletter, which if you're not on, which if you're here, you probably are on. If you're not joined, it only comes out a couple of times a year, and you can just join that very easily. And we publish those construction costs on that each year. Process, I guess, when to talk to us. Before you buy, you might be running numbers and get an idea of what sort of deductions might be there. When you settle, you want to start making deductions, so probably a good time to talk to the BMT reps. When it's tax time or tax time is coming and you haven't done it and it's time to do it, think about getting money, or if you renovate. Remember, as we said, call the coin surveyor before you rip it apart, just in case there's any things there that you can still claim. We will have a look at whatever information we have, make sure it's valuable. Even if you are claiming something and it's not as much as it can be, you can actually do those adjustments for the last couple of years for the difference as well. So, I mean, the first thing is you've got a property. If it hasn't been done properly or done by us and you're not sure, you're just claiming whatever, then we can have a look. We can see if there might be some deductions there. And then, we say, go ahead, we go out, information about your property, do the site inspection. Always my staff, as I said, do that around the country. That's why there's a couple of hundred of us spread all over the place. Go through, work it out, find out what's there, take some pictures, then prepare the report, start claiming some deductions. Process should be pretty simple. We organise the inspections. We talk to the councils about ages of building. Anything we can find, we will find, and we'll need some bits of information from you as well. Thank you. I hope you guys all and girls learnt plenty from that. There's lots of deductions potentially available to those commercial property investors. If you have bought or you're looking to buy, we'd love to help you out with those. And as I say, as we see, we're situated around the country. Thank you very much for listening and learning.